Well, it was a week of hawkish central bank surprises last week. The Bank of England raising rates by 50 basis points, double the size of the hike that markets have been expecting, with the Norges Bank joining in the 50 basis point club as well. Central bank speakers also striking a hawkish tone. Fed Chair Powell reiterating that he sees more hikes coming before the end of the year, and the ECB continuing to tee up a move, not just in July, but in September as well. Amid all of this, economic data showing signs of softening, some rather poor PMI figures out of the UK and the Eurozone towards the back end of last week, and US jobless claims continuing to rise as well. So equities slipping for the first week in 5, but it was a range-bound week of consolidation in both the FX and fixed income space. Actually, that's a bit of a theme that could dominate this week. We do have a quieter week when it comes to macro events, data releases, but we do have the end of the month, the end of the quarter, and the end of the first half of the year in the mix as well, which could still provide some fireworks. Another busy episode of The Trade-Off awaits, so let's get into the show. So plenty as always to discuss this week. Without further ado, let's bring in my co-host Ryan Littlestone from Forex Flow Live and Forex Analytics. Ryan, I've got one question to ask you this week. Where are we going for lunch and when?
Well, that's just what I'm scrolling through on my phone now to see where you're taking me for lunch. I thought you might want to get that in early. Yes, we shall decide the venue. I'm looking at some rather exclusive restaurants, of course. Might as well make the most of it.
Well, exactly. You may as well. I was going to say there's some nice fast food joints that have opened up around the corner from the office.
You're not taking me to Benji's, mate. No way.
Oh, I think they're long gone. You're showing your age there, mate.
Yeah, probably last time I was at the city, actually.
Probably is. Well, we're both dressed the same today. We're both in pink. So let's get into the show and we're going to start with the Bank of England so we can decide where I'm going to take you for lunch during Topical Thunder. Well, it was a bit of a surprise from the BoE on Thursday, certainly to me, I'm sure. Just to clarify that remark in terms of lunch, if people have just randomly clicked on this show for the first time in 6 months, firstly, where have you been? Secondly, the lunch reference is a bet that Ryan and I had probably, 4 months ago now, 4.5 months ago? It was a while back. Around where the Bank of England would get the bank rate to. And at the time, I said that 5% was punchy and I didn't think we'd get there. Well, last Thursday, we did get there. The BoE raising rates by 50 basis points. So we went from 4.5% to 5% on bank rate. That was compared to the 25 basis point move that both markets have been pricing in and that economists have been expecting. But it was actually, pretty much as hawkish as the BoE could have got when you actually look at the decision. Because on the 9-person Monetary Policy Committee, we always knew that Temrero and Dingra would vote for rates to remain unchanged. But of the 7 policymakers who voted for a rate hike, all 7 voted for that 50 basis point move. So that tells me that the BoE have really been quite panicked and quite shocked by the tightness in the labour market and that extremely hot earnings growth that we saw in April at 7.2%. And perhaps more importantly, the day before the BoE meeting last week, we had the latest core inflation print out of the UK, and that was rising by 7.1% on an annual basis in the month of May, which not only is that a 30-year high, not only is it considerably above the BoE's 2% target, but it's also continuing to accelerate. And I think that's really a concern when you look at the US, core inflation rolling over, Europe, core inflation rolling over, although we get the next CPI number later on this week, which I'm sure we'll touch on momentarily. But in the UK, the data is continuing to go in the wrong direction. And I think that really sort of forced the BoE's hand into that larger magnitude rate rise last week. The question now is, how much more do the BoE deliver? And I'm really going to throw that over to you in a second, Ryan, because given my track record of late, I don't think I'm in any position to even try and guess how much more the BoE deliver. But actually, I think we're still fundamentally dealing with the same situation here in the UK economy. You've got a slowing growth. The PMIs on Friday weren't particularly great. The housing market is very fragile, and the government rhetoric there in terms of help for mortgages is quite worrying because it could undo a big chunk of what the BoE are trying to do with interest rate rises. But I think, given that the market continues to price a terminal rate of around 6.25%, looking at the Bloomberg pricing before we came into film, the bar for another hawkish surprise seems a relatively high one. But I think what's more interesting, and I'll throw this over to you in a second, is that you look at what's happened to the pound. We've had three really key events in the UK over the last 3 weeks: the jobs numbers, the inflation number, and then the BoE decision on Thursday last week. And sterling's reaction to all of them has been the same. It's been a pop higher as the data comes out or the news crosses the wires, and then it's sold into very, very rapidly. And I think, to me, given that detachment that you see between the pound and gilts, maybe it's a sign that markets are starting to lose confidence in the old lady a little bit.
Well, I'm going to take the other side of that, because I think what we've seen over the last few weeks, as we've been saying, is that we have seen Bank of England expectations rising. That's why cable's been so well bid. That's why euro sterling's been on the slides, or pretty much since May. And that was the market getting a bit more hawkish over the Bank of England, because it's seen the data coming out, particularly inflation. It sees that, the one before the BoE meeting we just had, Bailey was going on about how he doesn't hope we have to hike again. And the market was seeing the data and thinking, right, no, you're wrong, you're going to be hiking again. And then this data came out last week, as you say, and it needed them to make that 50 pip move to pretty much catch up. So they're pretty much behind the curve all the way through this. This has got them, in my opinion, where they should have been previously. As you know, always said it was going to 5%. The nature of the beast, it's always more sticky in the UK inflation data. And so they've got themselves where they want to be, but now the market is happy with where they're at. They were thinking they were going to have to go this high. So it's really a case of, almost buy the rumour, sell the fact situation going on. I think what we're into now is the market doing its usual thing, running from one side of the boat to the other, and getting a bit too extreme now on, the terminal rate, if you will, the ceiling for rate. 6.25, I think, to coin a phrase, is a bit punchy. But for me, my market is probably 5.25 to 5.5, maybe an outside chance of 5.75 if we really see some sticky inflation data still. But I think the clock is going to be on the Bank of England side. And probably from August, so that'll be the July CPI readings, we may start to see inflation coming down, as they've been hoping it was going to do for the last few months. And that's when I think it won't be a pause. They'll maybe try and sell a pause, but I think that'll be a top when we start seeing that data turn over.
Yeah, I agree. I mean, the word punchy is infamous on this show now, and I think 5.25 is probably where I would pin things at this point. I think the market's probably got a little bit ahead of itself in terms of pricing in. It's a bit of a knee-jerk move on the back of the labour market and the inflation data, and you would hope, looking at the leading indicators, the PPI numbers, there is some disinflation in the pipeline, so maybe we will see that come back a bit. Speaking of getting ahead of ourselves, our producer, Kyriakos, has moved our titles on to the next topic, so I think he's trying to chivvy us along and make us speed up a bit this week, right?
Yeah, definitely. So we better get into this quickly. Yeah,
I was going to say, he's going to tell us off otherwise, isn't he?
Yeah, he needs to wave a little flag in the corner where we can see him. But we're going to talk about the data again and what life is like after this central bank period that we've had, which has been obviously really heavy with news about what the central banks are doing. Last Friday was really, for me, a clear example of what trading data dependency really means. We've got the Eurozone PMIs coming out, and as you said, not too hot on the screens. And Euro got hammered all through the PMIs. UK retails came out. They were fairly okay in the morning. The pound rallied small. Then we saw the US data as well. And we got, again, disappointing numbers, particularly in manufacturing from the PMI. But services dropped a bit, but wasn't as bad as what we saw in Europe. And yields and the dollar rose quite significantly. I think this is going to be how markets react as we move forward. Barring any big upside shocks to inflation, we know central banks pretty much are near the end of their hike cycle. So really going to be trading the how high and for how long they can keep them up for game. So trading the data is something that we need to be particularly focused on now. We are going to get some decent volatility around it, but it's also quite a difficult thing to do these days because we're not in the same league as the algos and robots who can move the market in nanoseconds as soon as the data drops. But if there's greater volatility over these data points, there's still going to be opportunities to grab a trade if you can get to the data quick enough, if you can read the data quick enough when it comes out. And on the other front, if you've got a piece of data that moves a pair out of sync with a longer running trend or theme of the day, that can present itself an opportunity for a little counter trade. I mean, think of something like the yen. If you get some data point that sends yen pairs lower, and we know it's been weakening and weakening continuously, then you think, well, maybe that piece of data has just knocked the trend out of sync for a moment. Maybe that's a little counter trend, a little dip I'd like to get into on that and see if it gets back to type. But yeah, for the data, I mean, I came from the lifelong. We used to trade data, human versus human. During the war, watching the screens, as soon as the data popped, whoever was quickest to hit the bid or hit the offer, got the trade. You can't do it these days with all this electronic trading. The market's gone. So it's a tough thing to do, but there's still some opportunities there.
Yeah, absolutely. There's still opportunity there. I mean, as you say, you can get those examples of mispricing where the market moves too far, too quickly in one direction. I mean, personally, the way I tend to use economic data now is, and I think most people know this at this point, I take a much longer term view of where the market's likely to be going. And when you get those economic releases, it's not necessarily about, where are the first 20 pips in the euro on the back of a Eurozone PMI. It's more, what does that PMI number actually mean when you think about the economy going forward? And you look at the Eurozone data that we got out on Friday, the composite number I think was a 5-month low. The manufacturing PMI was at its lowest level since pretty much lockdown, I think May 2020. And then you start to dig into some of the leading indicators and you say, well, actually you look at what are new orders saying, what's employment saying, where are the prices paid measures, and then that, if you're taking more of a longer term view of things, helps you to build up a picture of how that fits into your broader thesis. Which economies are slowing quicker than others, and then you can help to answer the question you posed at the very beginning, which is central banks are getting close to terminal levels. Who stays there the longest, and who has the highest terminal level? Who comes down from there the quickest? And that is going to depend on the data and on the nuance within that data, not necessarily on the initial market reaction to the print.
No, you're right. But I think based on what we saw Friday, I think there is great opportunity, particularly for the scalpers and the short-term traders, to maybe get in on a data point, because we've had NFPs that have moved the market 20, 30 pips. I think now we're looking at the possibility that something as big as NFP, we could see a 100 pip move, 150 pip move if the data has a big variation in it. So, we have to learn to change with markets. And if markets are going to change from a certain way, a certain type of volatility, something that worked for the last 6 weeks might not be working for the next 6 weeks. And you've got to identify that as traders and change with it.
No, you're very right. I may be slightly biased because when the data was coming out on Friday afternoon, I was sat in our Pepperstone hospitality tent sipping Nightimber in an air-conditioned Queen's Club, which was much more preferable to sitting in front of Bloomberg, let's be honest.
Oh, yeah, thanks for the invite.
Got lost in the post. Move on. Kyriakos, press the button. Come on, quickly, move on. Dollar yen. I want to talk about the yen because I think things are getting interesting over in Japan, and also because it bails me out of that rather sticky situation. The yen has been sold pretty relentlessly of late. I think we're seeing some quite concrete signs, actually, that the carry trade is starting to make a comeback into the FX space. We're seeing some sharp weakness in the yen, and we're seeing some real demand come through for some of the higher yielding currencies. I mean, we touched on earlier the rally that the pound had. One of the big reasons why sterling performed so well was this hunt for yield. It was this expectation, or the expectation's still there, that the BoE will raise rates for longer and to a higher level than their G10 peers. And you're starting to see that carry trade play out a little bit more. But of course, the problem with that, if you're sat in the Ministry of Finance in Japan or in the Bank of Japan itself, is that it results in a significantly weaker yen. And I think we're starting to see some signs. I know you and the guys over at Forex Analytics and Forex Flow have been very much on the ball with this. We're starting to see more and more comments from Japanese officials, particularly on the government side in the cabinet, not necessarily noting concern with the moves that we've seen in the market, but telling us that they're watching these moves very closely, which implicitly tells us that they are quite worried about what we're seeing, as we saw, incidentally, in the fourth quarter of 2022, where we had this verbal intervention, this jawboning, and then it became monetary intervention, which knocked dollar yen, a fair few big figures lower. Now, I think there's an important justification to draw here between the fundamentals of the yen, which do seem to justify a weaker currency. You've got a Bank of Japan that seems very reluctant, as we've mentioned many a time, to do anything in terms of tightening policy. And Bloomberg had their latest Japan survey out, I think, last week, and the majority now expect them not to do anything this year. But the problem that the Japanese authorities have is with the speed of the move rather than the absolute level of it. And this is where you start to get into the territory of the market becoming dysfunctional or disorderly. And that is when they may look to step into things. So I think the carry trade, that wave is certainly being ridden at the moment. But I think the punch bowl could get taken away relatively quickly, particularly if we see we're trading at 143 today. If we see a quick jump to 145, 147, that's certainly going to pique the authorities' interest, you would expect.
Yeah, well, as you say, we've had a step up in rhetoric over the weekend and this morning. We're probably two steps up from where we were on Friday. Both the Cabinet Secretary Matsuno and Finance Minister Suzuki both coming out and just raising the level, the threat level. But we're still a couple of 2-3 steps away from when we get to, pretty much next to intervention. And that's when they start throwing in the speculative angle, i.e. they're seeing speculative moves or moves not in line with the fundamentals. Now, a lot of people are putting 145 on their charts as a level for which the Bank of Japan, the Ministry of Finance would intervene. They don't look at levels. It's all about how hard the market's moving, how fast it's moving, the volatility. So we could go from here to 145, but if it takes 2 weeks, they're not going to intervene. If we go from, like you say, here in a couple of sessions up to 145, 146, 147, that's the volatility they're looking for. That's when, alarm bells might start ringing. But I think for the carry trade, a lot of this has been put on last week, over the last couple of weeks, with all these central banks still moving and the Bank of Japan doing nothing. So, a lot of these trades are going to be in at much, much lower levels. So even if they do get hit for a couple hundred pips, if we're at 147, it's only going to bring them down to 144 maybe, and they're still going to be on side. So I don't think we're going to see any of the carry traders folding up because you can take a little bit of movement on the FX. When you're sitting on one side, you've got minus 10 pips in Japan. On the other side, you've got 5.5% on any other central bank you want to look at. So it's going to take a lot to really shift the carry mob out. But if the finance minister decides to go on a proper intervention spree and they want it much, much lower, then that's when we've got to look to see whether we are going to find a big top and whether they're going to get some serious downside. But I don't think we're in for it much yet.
No, and of course the other consideration that you've got there is even when intervention does happen, does the market go with it or does the market fight it? Who then wins that kind of tug of war? It's a very interesting game, and it's one that they got away with quite well in the fourth quarter of last year, but it's one that doesn't often end well for a lot of central banks, isn't it?
No, but you've also got to know the context of this move. When we got that move last year, dollar yen, moved a huge amount, nearly 4,000-5,000 pips. A huge part of that was what the US was doing, what the Fed was doing, raising rates. So if you look around your charts, the daily or the weekly charts, when dollar yen was hitting those highs, euro dollar cable, they were hitting lows. But this time it's different. We've lost the input from the US side. So this is mostly pure yen weakening rather than dollar strengthening and other currencies weakening as well. So it's a different it's a different ball game now. This is Japan out on its own, and that makes it a bit more dangerous for the Japanese as well, but also to mark intervention.
Yeah, absolutely. Well, let's move on. I think you mentioned half year end flows last week, and it was a little bit premature. So we are in the last week of the month, so you can get away with it this week.
Yeah, well, yeah, we're here now, and it's going to be a busy time for markets this week because we are approaching the month end. This one is always a particularly interesting time because it's also quarter and half year end, and that can bring a lot of fix action throughout the day. The half year end fix can be extra busy because some funds, they close off positions for profit reporting and to rebalance allocations. But we're not limited to the end of the half. The first couple of days of the new half or new month can see the same sort of action when, these funds and whatever, they put on positions. So, for example, if, you've got a fund that's got an allocation 60% in bonds, 40% in stocks, and at the end of the first half of the year, they made on their bonds and made on their stocks, and maybe they've got 63% and 43%, so they're over allocated. They have to get those levels back down.
Sorry, Ryan. Yeah. Can we just do those percentages at 63 and 43%? What does that come to as a total?
It comes to over. Yeah, it comes to over 100% because obviously the markets can move, can't they? So
very true.
If you've bought 100 quid's worth of bonds and your profit. And
I see the way you do the comparison. Sorry,
yeah. So you've got 110, so you're 10% over your allocation. You've got to bring that back down to 100 quid for the next period. Keep within your allocation. So you have to sell assets in one aspect, but then also depending on what assets you're in, you've got FX exposure. So it's all a big rebalancing move to get your levels back down. Take profits, whatever, because a lot of firms also do 6 monthly reporting. So you need to show your profits on the books, and the only way you can do that sometimes is to actually physically close off trades. Those trades can then be put on the first day of the new month, and off you go again for the next 6 months. But these days, when we're talking about the fix, players are a lot more dynamic in their month-end trading now. In the old days, and usually it was done at the big fixes, the 4 o'clock fix in London, for example. But now it's spread out. We can see moves every hour during the mornings into the afternoons. But really, the main fixes are the Tokyo fix in Asia. We get an ECB fix during the sort of mid-afternoon, and then we get the London fix at 4 o'clock. So we can see moves happening all the time. But this week is going to be particularly funky for moves. Take the London fix, we can often see fix moves starting some 25, 30 minutes before, and you suddenly start seeing moves happening. So if you see sudden moves out the blue, look at the clock. If it's round about on an hour mark, likely it's going to be a fixed move.
Yeah, you're absolutely right. And as you say, it's just these are unpredictable. I mean, especially in the FX space, you get banks putting out models all the time saying, we're going to have dollar buying or dollar selling or whatever it is into month end. Well, it's proper finger in the air stuff. No one really has a concrete idea of which way it's going to go. And I think it just speaks to the importance of managing risk on any open positions, but also in terms of being nimble, because if we do see, for instance, a big rally in the pound into a 4 o'clock London fixing, it is going to be heavily flow driven. There is a chance that could reverse once we move through the fixing period and those orders have been worked through and filled. So in and of itself, not only is it a cause to manage risk and be a little bit more prudent, but it can provide some trading opportunities out there as well, either to go with the move or to fade it if you so desire.
Yeah, it also gives you a lesson of why you can go higher than 100% of something.
Yes, indeed. It's been a long day. It's only 2 o'clock.
Only Monday. Come on.
I'm blaming the sun. I caught the sun too much at the weekend. Right, let's have a look at some charts. An intro seems to get longer every week, I think. Right, what are we starting with? Cable, I want to start with this week. the pound didn't really benefit from the BoE last week, despite, as I said, a hawkish surprise, both in terms of the rate move and the vote split. So this and the detachment that we've seen from gilt yields suggests to me, rather happily, as one of the biggest sterling bears around at the moment, that we could be in for a little bit of downside. Although it's interesting that we've managed to hold on to this 126.70 level, which, if you think back, was the top of the range that we traded, and we had sort of 3 attempts before finally getting through it earlier in the year. That now seems to be establishing itself as quite solid support. So I think if you are looking to play cable from the short side, that is the level to keep an eye on initially. If we break below that, then maybe we look back down towards that 125 handle. And you've also got the 50-day moving average lurking in there as well, around 125.30. And of course, to the upside, the cycle high comes in around 128.5. But personally, I'd be looking to sell rallies and play from the short side. But I don't anticipate, unless we do get a closing break of this 126.70 level, we may just be in for a period of consolidation. And of course, we're going into the summer as well. Volatility is low, both on a realized and on an implied basis. You look at the data calendar this week, there's not really too much out when it comes to the UK. So you could actually make a relatively solid case to say that we just range sort of 26.70, maybe slightly below, to 28.50, maybe a touch above, for the next week or so.
Yeah, I agree with that. I think it was pretty significant, the price action, as you say, after the Bank of England and all that data. We didn't make fresh highs, we didn't bust that 128 level, and we've come down again, and we're below 128, and we've got this 127, 126.70 level. And if you look at techs, if you trade the techs, it's tech perfection. As you said, it's a big, long historical level that's been in place for months, and it's holding on the dips, and that's simple to trade. You need a move back up 128, 129 to think about a move to 130. If you don't get that, if we can't break those recent highs, that tells you a story, and then you can look to play the range, and then if need be, go with a break. So yeah, I'm on that side of you, but I'm a bit more neutral on the pound now than I was prior to the Bank of England and all that CPI data.
Yeah, I think the one thing that is kind of playing on my mind at the moment with sterling is the fact that, if it can't rally when the BoE are trying to stand out there as one of the most hawkish central banks, then what could cause it to rally? It feels like sterling may have kind of front run those expectations a little bit. But of course, the other thing to bear in mind is if we do see sterling take a leg lower, that's only going to import a little bit more inflation, and that then makes the problem even worse when it comes to the price pressure side of things. And that problem is bad enough as it is without having to import more from overseas. Let's be honest.
Yeah, you're exactly right. We can say, oil prices, and I'm going to look at that in a moment. They've been, pretty laggard really, and not bullish at all. And meanwhile, the value of the pound has gone up, which means that for us as a big importer, it's getting cheaper to buy that oil. So for once, it's going the right way for the Bank of England in terms of added inflation pressure. But you're right. If the pound does start falling again and we see it all rising, then it's a bit of a double whammy on the other side. But that's why I think that the Bank of England have got it probably right on the clock in terms of when they start to see inflation turning.
The BoE have got it right. That's the first time those words have ever been uttered on this show, isn't it? Right, Ryan, what about oil? You mentioned it there. Let's have a look at more detail, shall we?
Yeah, well, we're going to look at oil, and it's really a commodity story because the data has really been saying, it's really bearish in the commodity space. And, on the global front, we've had all these manufacturing PMIs. They're all heavily in contraction, and the last round have showed they've gone even further into contraction. And that's not bullish for commodities overall. And we look at the US WTI, and that spent the last week or so climbing off that 66 area again. Spent all week trying to do that, 7-8 days trying to do that, and then gave it all up in 2 days after we got the bad manufacturing numbers. Brent did the same thing off the sort of 71-60 area. We can't get a real good bounce in oil at the moment, and that's not surprising that's happening with the data coming in. I'm surprised it's not lower, the fact that the data keeps collapsing. And the fact that we just in WTI can't get through that 73, 74, 75 handle is bearish enough, whatever's going on with the data. So I think we may be setting up for a proper break lower. Of course, we always have to keep an eye out for the market manipulators, the producers like OPEC who will try to prop up prices, when they wish. But even their most recent moves haven't yielded much support for prices. The last one where the Saudis told us, be careful, you may get another gap up. We got a little gap up and it lasted about 10 minutes. So the market isn't yet ready to buy into commodities and oil, and that's because of the data. But I think if we break here in WTI, break these lows around 66, we've got the big figure at 60. That's the obvious target. But under there, we've got the 61.8 fib of the 2020-2022 move down in the 56.44. And that could be a bit of a more watershed moment if that breaks and, the bottom might be falling out.
Yeah, most definitely. I mean, crude is an interesting one. You've got a lot of moving parts going on here, as always. As you rightly alluded to, the manufacturing data is not great. The PMIs last week were, as we alluded to, pretty poor. The situation in China, the whole kind of reopening, recovery, optimism narrative has pretty much evaporated entirely at this point. And the question is now, how much stimulus will the government deliver? And over the last week or 10 days, it does feel as if the announcements that we've seen in terms of further loosening and further fiscal spending have fallen considerably short of what the market has been hoping for. I think what's interesting from a technical point of view, and if you look at a weekly chart, which I think this may well be, actually, I can't quite see from where I am, it's the 200-week moving average that WTI has tested probably 5 or 6 times now at this 66, 67 level and hasn't been able to break through it. As you say, the bulls have really valiantly defended that region. But given what's going on the demand side, it does seem a question of when rather than if that level is going to crack. And particularly given what seems like quite the impotent nature of OPEC, they've delivered 2 surprise production cuts now, and neither has caused any sustained move higher in prices, nor has it really put much of a floor into the market. It does feel as if the direction of travel is lower here. But of course, you do have that spanner in the works. So certainly if you were looking to trade this from the short side, which both the fundamental and technical side of things would, to me, suggest that I would want to be doing, I certainly wouldn't want to be holding any positions here over the weekend, just given the potential that we have for surprise. We've seen them do this hundreds of times before, and there's every chance that history could repeat itself again.
Yeah, definitely. There's always that risk, and you get geopolitical risk like we had with Russia this weekend, which also can have an impact on commodity markets. But sometimes trading is as simple as looking at a situation, having a balance, finding reasons why you'd want to be long and reasons why you want to be short. And at the moment, I don't find as many reasons to be long as I do to be short. In fact, quite the opposite. I find enough reasons to be short and looking for a move lower than for a move higher. But you need to beware of that risk, because if you do get something that changes, the upside's going to come pretty hard and fast at you.
You would expect so. Let's move on. Let's stick with commodities. I want to look at gold this week, which is not something we cover not something I cover particularly often on this show at the very least. And the reason for that has been for the last 3 or 4 weeks has gone absolutely nowhere, to be quite honest. We were stuck between about 1930 and 1965, 70 to the upside. But we finally made a break out of that range last week. We broke below, and closed below the 100-day moving average, which you can see on that chart there, the green line. We tested on umpteen times. It was almost a daily basis. We'd get a test of that 100-day, and very quickly the price would rally off it. And the next day we get another test, and we'd rally very quickly off it again. But importantly, we closed below it last week. We got that break on a closing basis, which did entice a few more shorts to come into the market. It may have run a few stops as well, given how important the level was. But I think it's interesting that the bears haven't really been able to flex their muscles at this point. And that's that's perhaps because this is more of a technically driven move, as I said, breaking that moving average and running a few stops, rather than a fundamentally driven move. I mean, if you consider the key drivers of gold, if you look at treasury yields, both on a nominal and real basis, they didn't really go anywhere last week. We didn't have any massive risk aversion in the market. Yes, equities were lower, but there wasn't really any haven demand. You didn't see the yen rally. You didn't see the Swissy rally. You didn't really see bonds rally either. The dollar has been pretty range bound. And when you throw all of these factors together, it does suggest and kind of explain why there's perhaps been a lack of follow through behind that break. And since we tested the lows around 1910. Given that we're below the 100-day, you would argue that you'd want to be playing this from the short side. But I think we could just be in danger of forming a new range here. We've got the low in at 1910 and support below that you can see in beige at 1900. And then the 100-day moving average, rather than acting as the support that it's been, maybe it's now just going to act as resistance. And we establish ourselves in another consolidation period, albeit at a marginally lower level than the last one that we've just got out of.
Yeah, very possible. And you might remember this was my trade of the day, play of the day last week, looking at longs into that 10, maybe even into 1900 for a bounce trade on that one. If you got in, well done. You know, you could have taken 10, 15, 20 ticks out of it. And yeah, I think that technically, again, it's looking very clean. The break of that moving average, holding below that moving average, you know, it's a tech dream. So, yeah, we could set up for a bit of a move, a bit of a tiny range, let's call it that, between maybe 40 and 1900, let's call it. Got to expect maybe a bit of an extension. But the price action is going to be key. You know, how often we come down to that 1910 low now, that's going to be something traders need to be careful of. If we keep bouncing, but it's looking dead cattish and we're testing that level often, that's when you think we might be setting up for a break down to the 1900, maybe even more. Conversely, more tests we get on that moving average, you're going to think, well, maybe we've got a bit of a bottom in play, and then we're going to get back into the old box. But I don't see this moving anywhere significantly. Like you say, on the fundamentals, technically, yeah, it's open for some moves back above that 1940. Yeah, back in the range up towards that 76.80 area, which is the top side and where a lot of people are playing shorts off at the moment. So yeah, we could be going to a new range here. It's looking very clear on what levels you have to trade.
Most definitely. What about EURNOK? I've seen your chart already, and I know I'm going to hate it.
I actually surprised myself with this one.
So Blake Morrow is crying tears of joy if he's got this far in this one.
There'll be a few people who will be sitting there going, "What?" when they see this chart. I mean, yeah. We're talking about central banks. I mean, you wouldn't tell with this one that the Norges Bank had just hiked 50 pips and are set to do more in August. And the NOK is back to weakening after all the central bank dancing. And we got a real big dip in this pair up off that 12 level. A lot of us were looking at shorts up there. I tried it. I got burnt around the 1190s, 95s when it made that move up. And then... I won't talk about the rest because it was all down here after that, typical FX timing. But we look like we might be heading up towards those highs in the 12s. So there's two things that could happen here. Either we are heading back to those highs and maybe moving higher, or we fail to reach those highs and we mark a significant top and then we face a steeper drop down there. I mean, the last move down from the highs, that couldn't get close to the 38.2 fib of the move up from September. Although that fib keeps having to be redrawn higher and chasing the price ever higher. So not a surprise it hasn't got there. Now, this is a bit that's going to shock a lot of people. There's going to be a lot of head and shoulders aficionados out there that might be eyeing a possible pattern developing here. And I've marked it on the chart there. I have to say, I'm not a head and shoulders man. To me, it's complete witchcraft, but I can't deny that people trade it and people look at it and it looks like it might be setting up for a clear one here. Now, as we've spoken about, the NOK weakness is not helped by the central bank, which is still selling tons of its own currency against oil profits, nor by the bearishness of oil either, which is another headwind for NOK strength. So, as I say, if we get another fail up near the 12 level, shorts might be able to get in again. But if we take out the highs, we might be on for a new journey higher.
Yeah. I know you're not a big fan of it, but if the Norwegian kroner turns, it's going to be because the central bank changed their policy and stopped selling the currency or as much of it, or because oil turns. It's not going to be because of some little blue lines on a chart or a big red arrow.
Listen,
you're a big red arrow going up.
You're trusting a moving average on gold, so people trust in your shoulders and whatnot, and little blue arches. So ours is not to reason why. Ours is just but to sell and buy.
That is very true. Well, I'm going to deliver a tonic to that because in my play of the day there are no technical indicators on it at all, and we'll explain why in a second. Tennis reminds me of Friday and Saturday. Such a lovely day. It's so warm. The sun. Oh, sorry, you weren't there. I'll stop. Right, our play of the day. I want to look at Japan this week. This is quite a Japanese-heavy show, actually. We were talking about the yen earlier, the Bank of Japan, FX intervention. I want to look at Japanese equities. And the reason why I want to look at this, and this chart, just to explain it, is a ratio, effectively, of the Nikkei 225, which was one of the major Japanese equity benchmarks, and the Chinese A50, which is one of the major Chinese equity benchmarks. And one of the big stories of the year so far has been this outperformance of Japanese equities, both on a sole basis, but also relative to their Chinese peers. And you've obviously got a big currency impact here. The yen is one of the weakest, if not the weakest, G10 currency on a year-to-date basis. So that's good news for Japanese firms with overseas earnings, of course, similar to the effect that you see with the FTSE. But there's a lot of structural reasons why the Japanese equity market should be performing well. You've got this big shift in Japan at the moment in terms of corporate governance, reforming the way that companies are run, making them a little bit more westernized. There's this encouragement from the government and also from the Tokyo Stock Exchange to return an increasing amount of cash to shareholders, either via buybacks or via increased dividend payments. And then when you start to think about the economic cycle, actually what's going on in Japan has become a little bit desynchronized from what's going on in the UK, the country, and in other developed markets, I hasten to add. There's very little sign of any sort of economic slowdown. And of course, the deflation, disinflationary beast appears to have been slain. So you've got that sort of uncorrelated nature of the Japanese economic cycle with its peers. So personally, I would be looking to get long Japanese equities, but I'd do it as a spread trade and be short China at the same time. Because another big factor in the move higher in Japanese equities is this idea of people wanting exposure to Asia, but they don't want to worry about China. So if you do get that big reallocation, because institutional investors, if you look at the surveys, they are underweight Japan. A lot are overweight China. If you do get that big rotation, that should have the impact of driving Japan higher and driving China lower. So there you go. My nice, clean play of the day this week. Ryan, what are your thoughts on, what is it, euro dollar, I think you've got?
Yeah, well, as usual, you've left me about 10 seconds to get my play of the day in. So
you can have as long as you want.
I'll make it short and sweet. I'm going to look at euro dollar this week. As mentioned, it can be a funny week to trade with all this month-end stuff going on. So I'm going to stick to a main pair, a well-liquid pair, just so I can keep out of the noise of what might have gone elsewhere. I'm really looking perhaps to short this one if we get another decent upside rally. Ideally, I'll be looking at 111, but I'll have to judge the moves on this one, see whatever happens during this week, because the early indications is that we're going to see a bit of dollar selling. That's from the bank models, as we spoke about earlier for month end. Certainly, I wouldn't look to be shorting under 110. So anywhere maybe between 110 and 111, if we're there or thereabouts, coming into sort of Thursday, Friday, that when we get the real end of month stuff dropping down. If we're up at those levels there, I'm going to think about a short. Keep a stock fairly tight above maybe sort of 11.20, 11.30 if we're up there. So, yeah, nice and easy for me, keeping it simple.
Nice. And you still went over time. Right, that brings us to the end of another show. Thank you very much, as always, to Ryan Littlestone from Forex Play Live and Forex Analytics for joining me. Thank you also to our producer, Kyriakos, who's finally worked out how to press the right buttons and bring this show together as brilliantly as he always does. If you've enjoyed the show, drop a like on the video, leave a comment as well. Let us know how you're trading the markets. And all three of us will be back again this time next week. Thanks, as always, for watching, and goodbye for now.